Okay, traders, now I just want to give you a quick beginner's guide to trading the economic data. All right, it's a pretty simple concept once you understand what you're looking at. Now, I've got here the New Squawk event calendar. Now, this is quite a good calendar because it includes a vast range of features. It's got the actual number, which is what we're looking for, the expected number or the forecast. It has the range of the data, the previous result, and if there's any revisions to the previous number, right? And of course, the impact. Now, the key to trading the economic numbers is understanding where the impact comes from, okay? Now, the first and foremost, the expectations, okay, sets the benchmark for the outcome. Now, if I'm looking for a trading opportunity, and this is sterling, so UK construction numbers, if we're looking for the impact to go down, you're looking for a number below 0.5, okay? That would push sterling down. Now, if we're looking for an opportunity to buy sterling, you're looking for an actual number to come out above minus 0.5, right? That's as simple as you need to understand from the very beginning, okay? So when you're trading, it's actual versus the expected number or forecast on many calendars. And that's it. That's where you get the initial move, okay? So the difference between those two, if the actual number is stronger than the expected number, the currency generally goes up. And if the actual number is weaker than the expected number, then it goes down. Right now, we can take this a little bit further, okay? The range of the data. So in this example, we've got the expectation of minus 0.5. So I'm telling you an actual number above or below that will cause a move either up or down. But what we can do is track the range of the data. So, and what does this mean? So all the respondents, all the financial institutions that have put in their averages to get the actual expectation, this is the range of their data, minus 1% to plus 0.5%. Now, what does that mean? Well, what it means is that's the whole market expectation for this number. Now, why is this important? Well, for instance, imagine the number comes out minus 1.5%. Okay, what does that tell us? Well, it's definitely, I just changed my pen to red. It's definitely above or below, sorry, minus 0.5. And it's below the low of the forecast. No one got this right. So what the market has to do is go and factor that in. So a number outside the range will give us a much bigger move. Okay, so if we get a number here, minus 1.5, I would be increasing my trade size. I would also be letting the trade run if it's outside the range of the forecast, right? And this is exactly the same for the top side. Okay, the high here for the expectation of this UK construction number, the expectation is minus 0.5. If it's above 0.5, okay, we are going to get an extended move. So if that number came out at 1%, I would be looking to increase my trade size and let the position run further because it's above the high of the range. All right, so just to recap, right? To start with, on the initial basis, it's the actual versus the forecast or the expectation. That determines the initial move. How big the move is, that comes from the range of the data, right? So an actual number that comes outside the range, you're going to have a pretty solid move and you want to look out for those opportunities. Okay, that's your beginner's guide. Good luck, traders. All the best. Cheerio.